What drains a trader the most is not losing one big trade. It's losing again and again, slowly, while living in constant tension. You know you're doing something wrong, but you don't know where the mistake is. For many years walking alongside trading, I've received countless questions from fellow traders. Brother, in the end, what is the core thing you rely on? Why can you remain still while the market keeps surging, sweeping away so many accounts? Each time I would only smile lightly, not because I wanted to hide anything, but because there are things that aren't meant to be spoken too soon. Trading has never been a smooth road. It is a journey soaked in sweat, sometimes even blood and tears. And precisely because of that, there are experiences, there are ways of doing things that I chose to keep to myself, kept as something necessary for survival. But today, on Quiet Trading, I've decided to do something I've never done before, to share with you a trading method that I formed with my own hands, paid for through countless falls. It isn't found in any textbook, nor is it a flashy indicator spreading across the internet. This method was distilled from thousands of hours sitting in front of the screen, from sleepless nights watching my account slowly erode, and from times when I had to start over from zero. I consider it the most heartfelt thing in my trading life. You might think this is just another magical trick, another promise meant to sound comforting. But no, I speak from everything I've lived through, and I take responsibility for every word. Because this method has never been made public. Even in conversations, in private groups, or with close brothers in the quiet trading community, I chose to remain silent. And only today do I feel that the timing is finally ripe to speak it out. In the next 25 minutes, I won't promise to turn you into a millionaire. I won't promise that you'll win every trade. What I can promise is that you'll see the market from a completely different perspective. You'll understand why most traders fail and how not to repeat that same path. I ask you to set aside your doubts for a moment. Let what I've been through guide you. Stay with me until the end of this video, because there you'll realize that trading isn't just about money. It's a process of growing up, a way for a person to forge discipline and willpower in order to survive in a harsh market. Welcome to Quiet Trading, where I only speak about what I've lived with, what I've tasted, and what's been etched deep inside me. If you're ready, let's begin. I still remember clearly the early days when I first stepped into the market. Back then, trading looked like a doorway to freedom. Financial freedom, time freedom, freedom to live life on my own terms. I rushed in full of excitement, my head filled with the belief that as long as I learned enough indicators and read enough books, wealth would be within reach. But reality was far more ruthless. In the beginning, I won a few trades and mistakenly thought I had found the key. I increased my position size. I got excited. I believed money came as easily as a game. Then, in just one night, an unexpected move wiped out everything, taking even the capital I had carefully saved. I still remember watching my account turn from green to red, then disappear in a matter of moments. That night, I sat alone in a dark room, the screen still glowing, while inside me there was only a cold, empty void. Slowly, I came to understand, trading isn't a game of luck, it's a battlefield. And on that battlefield, those without discipline are eliminated without mercy. But I didn't stop. I fell, got up, lost again, fell again, and forced myself to stand once more. Each failure cost me money, but in return, it gave me a lesson. I learned to look at the market with the naked eye, no longer relying on tangled indicators. I learned to restrain greed, to remain calm even when everything went against me. And gradually, through months of sitting for hours in front of the screen, watching each candle, every subtle movement of price, I realized one thing. The market doesn't move randomly. It has its rhythm, its pauses, its moments where crowd psychology reveals itself most clearly. It was in those places that I saw opportunity, and it was there that the seeds of the method I'm sharing with you today began to take shape.
It didn't come from any book,
Nor did it originate from an online forum. It was shaped through countless sleepless nights, through account collapses that hurt deep into the chest, and through a level of patience that bordered on obsession. Trading took a great deal from me. Money, time, even relationships. But in return, it gave me something far more valuable: maturity and a battle-tested method solid enough for me to survive and keep moving forward. Today, I'm telling this story not to show how much I endured, but to help you understand that the method I'm about to share isn't something made up to sound good, nor is it a trick to chase views. It is the distilled result of an entire journey. A journey that if you've ever walked it yourself, you'll feel that every word is soaked in sweat and blood. And that is precisely why it holds value. Let me take you deeper so you can see where the true roots of this method really lie. My friends, at this point, I want you to take a deep breath, because what comes next may change the way you look at the market entirely. The core of this method can be summed up in one principle: never try to predict the future. Most traders fail because they enter the market with a forecasting mindset. They believe price will go up or go down, then place both their capital and their faith on that prediction. But the market doesn't care what you believe. It moves according to crowd behavior, money flow, and above all, human psychology. My method doesn't seek certainty. I don't need to know where the market is going. Instead, I focus on observing zones of psychological imbalance, places where the crowd is trapped. Think of the market as a battlefield. There are always buyers and sellers. When too many people lean heavily to one side, a gap appears, a weakness in the formation. It is precisely at those weak points that large capital steps in, and the market often snaps sharply in the opposite direction. That is the moment I act. I don't step in while the game is still unfolding. I wait, I observe, I remain patient until the market exposes its imbalance on its own. That is where the crowd's stop losses are concentrated, where a small push can trigger a chain reaction, creating a powerful flow, and I move with that flow. The principle may sound simple, but to turn it into a method that keeps you alive, I built an additional structure, what I call the 3 layers of defense. The first layer, identifying imbalance zones purely through price behavior without relying on any indicator. I observe candles, volume, and how the market reacts. The second layer, entering with a small position as a probe. Only when the market confirms direction do I gradually add size. If it doesn't, I step away with a very small loss. The third layer, capital management through strict risk locking, always keeping risk at least 3 times smaller than expected reward. That means even if I win 3 out of 10 trades, I remain profitable. Do you see it now? I'm not gambling with the market. I'm not hoping for luck either. I simply wait patiently until the market reveals its weakness, strike at the right moment, and leave once the objective is met. Let me repeat this once more. This method is not a rigid formula. It is a combination of price behavior observation, psychological control, and disciplined risk management. These 3 elements form a solid structure. Remove just one, and collapse comes sooner than you expect. You might be wondering, if it's that clear, why can't everyone do it? The answer lies here. Humans are terrible at waiting. This method forces you to let go of many opportunities that look attractive on the surface. It forces you to sit still, allowing the market to expose its weakness on its own. And that stillness is the greatest challenge of all. It took me many years to train this patience. Countless times, far too many, I rushed in too early and paid a heavy price. Only when I learned how to hold myself back did I truly feel the power of this method. So don't see this as some divine secret. It only works when you accept the discipline of training yourself, not when you're just collecting a few clever tricks. That is the core of what I want to say today. But to help you truly feel its weight, let me walk you through a few examples. In reality, these very trades are what prove that the method doesn't just exist on paper, it operates right in the middle of the harsh battlefield of the financial markets. To make it concrete, I'll explain exactly how I apply this method, rather than stopping at vague concepts. The first step is observation. I don't rush into a trade, and I don't try to guess where price is headed. I wait for the market to speak for itself. What I focus on is imbalance, areas where buyers or sellers dominate excessively and expose weakness. The second step is marking the zones where I believe the crowd is trapped. These might be price levels everyone believes are strong support or resistance, places where stop losses are clustered, or points where fresh news has just appeared and people act emotionally. It is precisely in these zones that real opportunity forms. The third step is action, but it is never blind action, it is prepared action. I always enter with a small probing position, like a scout. If the market confirms direction, then I add to the position. If it doesn't, I step out with a very small loss, almost insignificant. The final step, and the most important one, is capital management. I have one rule that never changes. Risk on any single trade never exceeds 1% of my account. As long as that rule holds, I know I still have room to return, room to correct mistakes. And when profit appears, I let it run far beyond the risk I took. That is the framework. But what truly creates the difference doesn't lie in these steps. In fact, you can find them in many books. I know, I've read nearly all the classic works on trading and finance, from Market Wizards to Reminiscences of a Stock Operator, along with books on risk management and crowd psychology. I read slowly, carefully, underlining every line. Yet there is one truth I have to say plainly. No book teaches you how to control your emotions when your own money is exposed in the market. No theory can replace the pounding heartbeat when price suddenly spikes or the suffocating feeling when your account turns red. That's why the method I'm sharing today isn't just knowledge, it's a distillation of both books and real combat. I read to understand principles, but only through losses, through painful falls did those principles become part of my flesh and bone. And that's why I believe this. If you listen closely enough, if you practice correctly, then what I'm about to share next, the specific trade examples, won't remain theory. They'll be something you can apply directly on your charts in the days ahead. So let's move on to the next part, where I take you into live combat. I'll walk you through the trades I placed, the levels I chose to enter, the moments I exited, and most importantly, my psychological state at each step. Because only when you see it clearly and feel it internally can you understand the true power of this method. I won't leave you with theory alone. I want to tell you about one trade that I still remember vividly because it captures the full strength of this approach. It was on Euro USD on a Tuesday night when the market appeared quiet, moving sideways in a narrow range. Many traders grew impatient. They jumped in again and again, hoping to grab a few quick pips. I was different. I stayed still. I observed. I waited for the market to reveal its weakness. Around 11 p.m., price moved close to a support zone that most traders believed to be a solid wall. I knew clearly that beneath that level lay a buildup of buy-side stop losses. And I understood that all it would take was a single push for those stops to turn into fuel, driving price sharply downward. I began to prepare. When a strong red candle broke through the support, I didn't rush in immediately. I waited for a few more seconds. Price slid deeper. That was my signal. I entered a small sell position, only a fraction of size. I needed confirmation. A few minutes later, price showed no sign of turning back. It dropped straight down, as if a door had been smashed open and a waterfall lay behind it. That was when I doubled my sell position. And just as I had waited for, price collapsed. In less than 2 minutes, the profit I made equaled an entire week of normal trading. The key point was never the profit number. What mattered more was the feeling that I had moved in rhythm with the market. I wasn't fighting it. I wasn't trying to predict it. I simply waited quietly until it revealed its weakness. and then acted at precisely that moment. Another example is on gold against the dollar. The gold market is notorious for violent swings where many traders win one day and lose everything the next. But with this method, I don't look for certainty inside sharp volatility. I look for opportunity in imbalance. That day, gold surged on news, pulling a wave of traders into chasing buys. I stayed still. I knew that after a heated run, the market would eventually lose breath. I watched each candle closely and noticed a price area where buying pressure was aggressive but unable to push higher. That was a clear sign of exhaustion. I placed a small probing sell. A few minutes later, price failed to continue and began to turn down. I added to the position, and this time the market collapsed quickly. While the crowd was trapped in long positions, panic-cutting their losses, I was positioned the other way, and the profit expanded naturally. But I want to emphasize one thing: neither of these trades was easy. I waited for hours just to act for a few minutes. I had to ignore dozens of false signals, opportunities that looked tempting on the surface but were in reality traps. And most importantly, I had to keep my psychology steady, not allowing impatience or fear to drag me into action. Do you see it now? This method isn't magic. It's the combination of patience, discipline, and acting at the right time. And to reach that point, I went through hundreds of mistakes. I read nearly all the classic trading books, studied every principle of risk management, every lesson on psychology. But only when my own money was exposed in the market, only after tasting enough bitterness did those words truly sink in. That's why these real examples aren't meant to impress. They serve only one purpose: to prove that if you know how to wait, if you can recognize imbalance, and if you manage capital like a warrior protecting his life, then trading stops being a gamble and becomes an art. There's a question I'm sure many of you are thinking about. How do I know where the crowd usually places their stop losses so I can wait and move against them? The answer lies in human psychology. The market is made up of millions of individuals, but they think in remarkably similar ways. And because of that, crowd behavior leaves very clear footprints on the chart. There are three places where crowd stop losses tend to concentrate. First, just below familiar support levels and just above familiar resistance levels. When price tests a support zone repeatedly, most retail traders buy there. They place stop losses just below it, believing that if support breaks, the trend has failed. The same logic applies at resistance. These areas become large pools of liquidity. When big money wants to move the market, all they need to do is break through those zones, triggering a chain of stop losses and creating strong momentum. Second, at obvious highs and lows, swing highs, swing lows, previous peaks and bottoms. This is where most traders place their stops. For example, after a new low forms, many traders buy expecting a reversal and place stop losses just beneath that low. These spots are favorite targets for large players because a simple sweep allows them to collect cheap liquidity. Third, after strong news candles. When news hits, price moves quickly in one direction. The crowd chases late, placing stop losses on the opposite side. But when the excitement fades, the market reverses, and all those stop losses are triggered, becoming fuel for the move back. I observe these zones through price action, through how price behaves. I don't need complex indicators. I just need to see price repeatedly reacting at a familiar support or resistance where stops are stacked. An unusually long candle after news when the crowd has just jumped in and stops sit on the other side. Or an extremely obvious high or low, so obvious that everyone can see it. That's usually the easiest place to hunt. To make this clearer, let's return to the Euro-USD example I mentioned earlier. The support zone below was exactly where a large number of buy-side stop losses were clustered. When price broke down, selling pressure exploded as those stops were cleared. I simply moved with that flow. This is the core point. The crowd always acts in predictable patterns. They place stop losses in obvious locations, and large players understand this perfectly, and they take advantage of it.
When you understand this, you stop being the one whose stop loss gets hunted, and you become the one doing the hunting. That said, I have to be honest, not every breakout is a stop-loss sweep. There are times when the market truly changes direction. Our job is to observe the reaction after the break. If price breaks and then accelerates strongly with increasing volume, that's a sweep backed by real money. But if price breaks and then stalls or snaps back quickly, that's a trap, and extreme caution is required. Being able to read that reaction is where the art lies, and that skill is something I sharpened through thousands of hours sitting in front of the screen.
So, to be absolutely clear, I don't know where the crowd places their stop losses because of any special ability. I know it because I understand human psychology, and because I recognize the footprints people leave behind on the chart. When you begin to see those footprints as well, the market gradually becomes clearer, no longer vague as it once was. Every trader has, at some point, been hit hard by the market. Price breaks through support or resistance with force, only to reverse minutes later and wipe out stop losses. That is a false breakout. When price keeps going and doesn't return, that's a real breakout. The challenge lies in recognizing which one it is while it's happening. I always rely on three factors. First, the strength of the breakout. A real breakout usually comes as a long-bodied candle that closes decisively beyond support or resistance, accompanied by strong volume. A false breakout often only pierces the level briefly, with long wicks, small bodies, and a close hovering near the zone. Second, the reaction immediately after the breakout. With a real breakout, price continues to move away and barely looks back, showing that large money is pushing the market. With a false breakout, price reverses quickly, closes in the opposite direction, and fully engulfs the breakout candle. Third, the broader market context. If a breakout occurs after a long period of accumulation, a multi-day sideways range, the probability of a real breakout is high. If it appears after an extended, overheated move, it is very often a false breakout designed to sweep stop losses. To make this easier to visualize, let me revisit an example on Euro-USD. There was a time when the pair moved sideways for many days around the 1.0800 level. Many traders placed sell stops above and buy stops below. When the London session opened, a strong red candle broke cleanly below 1.0800, closed well beneath it, and volume expanded noticeably. I recognize this as a real breakout. I entered short on a small pullback, and within a few hours, Euro-USD dropped straight to the 1.0760 area, delivering profits many times larger than the risk. But there was another occasion. Euro-USD had rallied aggressively over several sessions and reached the 1.000 level. A psychological level everyone was watching. When price poked above 1.000 with a green candle, I didn't rush in. I observed carefully. A short body, a long upper wick, and a close not far from the level. I became suspicious, and rightly so. About 30 minutes later, the market reversed sharply, wiping out late buyers. That was a textbook false breakout. You see, this is the core of it. Real breakouts are strong and decisive, occurring after consolidation. False breakouts are hesitant, reverse quickly, and appear during excessive excitement. Never jump in just because price crosses a line. Wait for the reaction. Just a few extra minutes of patience can save you from countless traps and significantly improve your win rate. Once you understand this difference, you stop being prey to the market. Instead, you stand on the side of the hunters. My friends, we've traveled a long path in this session. From viewing the market as a psychological game to observing imbalance, identifying where the crowd places stop losses, and distinguishing false breakouts from real ones. But the most important thing I want you to remember is this. Trading is not a game of indicators, nor a gamble driven by luck. Trading is the art of reading human psychology and mastering yourself.
I've read nearly all the classic books on trading and finance. I studied every page, then discarded what was detached from reality, keeping only what could be applied in real trading. And after all of that, I realized knowledge is only the starting point. What ultimately determines results is patience and discipline. You need to understand one truth. Winning often or losing rarely is less important than winning the right way. With just a few high-quality trades and proper risk management, you can recover from dozens of small losses. Don't enter the market with the mindset of making money fast. Enter it with the mindset of a warrior, accepting sacrifice, accepting tuition fees, and committing to the path you've chosen. That perseverance is what forges a true trader. Remember this, the market promises nothing to anyone. It only rewards those who are patient enough, disciplined enough, and clear-headed enough not to be dragged into the crowd's traps. When you can see what lies behind each breakout, when you can feel fear and greed embedded in every candle, that's when you truly touch the core of trading. And the final message I want to leave you with today is this. Trading is not about fighting the market, but about moving in harmony with its rhythm. Those who know how to wait, who know how to hold themselves steady, are the ones who survive and go far. If you found value in these reflections, leave a comment and share your thoughts. And don't forget to subscribe to Quiet Trading. In the next videos, I'll go deeper into risk management, the final piece needed to complete a sustainable trading system. I'll see you further down the road.